Welcome to Commerce and Management Solutions. In this video, we will discuss how to determine the market equilibrium. So to determine the market equilibrium, we must consider two factors. One is demand and supply. In any market you take, the equilibrium will be determined on the basis of the demand and supply inside the market. And before that, before moving to discuss about this table, please understand what is equilibrium. Equilibrium is the point, equal point. It can be said as equal point. Here in a market, always equilibrium point means when demand is equal to supply. That is called as equilibrium point. Equilibrium of the market is demand is equal to supply. So from this table itself, you can understand that what is the equilibrium point. Here we can see that you take the demand here 180, 60, 40 and 20. Then supply 20, 40, 60, 80, 100. So here you look at here at the price 30. At the price 30, the demand is 60, supply is 60. So we can say that this point is called as equilibrium point. So here I have taken the demand according to the quantity, demand and price. We know that it is an inverse relationship. When price increases, quantity demand will decreases and supply is increasing when price increases. And we need to determine here, we need to take down here the differences, means excess or deficit in demand first we need to calculate, and excess or deficit in supply also we need to calculate here. So here we will write down here excess in demand. Here 100 is there but supply is 20. So here we can say it as demand is excess. How much it is excess? 80 is excess here in that case. Then here on this side we can say here it is 80 excess. Then here we can say it is deficit in supply. It is not excess. Here it is deficit in supply. How much? 80 is the deficit in supply. Here excess demand, how much? 80 is the demand but supply is only 40. So we can write here it is 40 is the excess demand. On the other side 40 is the shortage of supply. But here there is no shortage or there is no deficit. Both demand and supply are equal. But come to this, here you can say that here 40 is the deficit demand. Then here 40 is the excess supply here, because demand is 40 but here the producer supplied 80 quantity into the markets. When coming to this, you can see here it is 80 is the shortage, means deficit is 80 but here it is 80 is the excess, because 100 supply is there but demand is only 20. So from this table itself we can understand what is the equilibrium point. So equilibrium point is that it is equilibrium point is 30. You can say at 30 price the demand and supply will be equal inside the market. So how it can be represented in the graph? So let's take this table, same table whatever we discussed already. So here we can draw the demand curve and supply curve in a graph. So let us draw the demand curve. So demand curve, we know that as per this information, that is when price is 10, demand is 100, price is 20, demand is 80. So the demand curve will be always downward sloping, as we all know that, and supply curve will be always upward sloping. So this is the demand curve and this is the supply curve. And let us take that intersection point. So here this intersection point, this is the demand curve, right? This is a demand curve and this is supply curve. This is demand curve and this is supply curve. At this intersection points, demand and supply are equal. So that we can say that equilibrium point is the point at which the demand and supply are equal. So here you can see the price, that is 30, you just take 30 is the demand, the price of the product, and quantity, demand and supply is 60. If you are supplying more product into the market, that means above the demand curve, you can say it is excess supply, means shortage, deficit of demand. We can say either excess supply or we can say it as deficit of demand. Both way we can say here it is deficit of demand. Then on the other side here, what is happening here? If you are fixing the price less than 30, the supply will be lesser, then demand will be more. If you are fixing the price lesser than 30, at the price 30, the demand and supply will be equal inside the markets. But at the price lesser than 30, the supply will be less, demand will be more. When price increases, obviously the supply will be more, demand will be less. That is a natural things in the market. You can see that if you are introducing a product into the market at higher price, demand will be less for that product. If it is lesser price, more demand will be there. So here, if in this case, like when demand is more, supply is less, we can say it is called as excess demand, or we can say here it is shortage of supply. We can say this is otherwise called as shortage or deficit of supply. We can say it as deficit or shortage of supply. So here we discussed about how to determine the market equilibrium.